So, have you ever wondered how a big bank braces for impact? For a massive financial storm? Well, today, we're going to pull back the curtain on a super important tool they use to do just that. It's called credit value at risk, or Credit VaR for short.
It really all boils down to one huge question that every single bank has to grapple with. How in the world do you prepare for the worst? And I don't just mean a bad day on the market, I mean a truly bad, worst-case scenario kind of loss. This is exactly where this powerful concept called value at risk enters the picture.
Okay, so this whole value at risk thing, or VaR, it's not some one-size-fits-all deal. It actually comes in two main flavors, and knowing the difference is absolutely key. You've got Market VaR, and then you have our main event for today, Credit VaR. Let's break them down.
On one hand, you've got Market VaR. This is probably what most people think of when they hear VaR. It's all about the potential losses from these big, sweeping market changes. Things like interest rates suddenly shooting up or the entire stock market taking a nosedive. But on the other side, and this is our focus, is Credit VaR. This is way more specific. It measures the potential loss not because the whole market went sideways, but because one specific company, one that you loaned money to, is suddenly not looking so financially healthy anymore.
All right, now that we've separated those two, let's really zoom in and get to the bottom of what Credit VaR actually is. What's the real definition here? At its core, Credit VaR is all about calculating the biggest loss you can reasonably expect on something like a loan or a bond. And you do this over a specific time, like, say, 1 year. And this is important, at a certain confidence level. So, for instance, a 99% confidence level means you're saying, okay, there's only a 1% chance that our actual loss will be worse than this number we've calculated.
And listen, this is the key thing to get. We're not just talking about a company going completely bankrupt and defaulting. Nope. We're often talking about something more subtle. The company's financial health just dwindling. Its credit rating gets downgraded. Now, even if they're still paying you back, that new, higher risk makes the bond you're holding less valuable. Credit VaR is what measures that drop in value.
So how do risk managers actually predict these losses? It sounds like magic, right? Well, they don't have a crystal ball, but they do have the next best thing, decades and decades of historical data, all packed into this incredibly powerful tool called the Credit Transition Matrix. Essentially, big rating agencies like Moody's have been tracking thousands of companies for years. They put all that data together to see, for example, what percentage of companies that have a BBB rating are still BBB 1 year later, and what percentage get upgraded, and, most importantly for us, what percentage get downgraded.
Okay, let's just pause here for a second, because this table, this is the engine that drives the entire calculation. Now, this is a simplified version, but let's focus on that middle row, the BA or BBB rated bond. See that first number? There's an 85.44% chance it stays exactly where it is after a year. But here's what the risk managers are really looking at. There's a 3.74% chance it gets downgraded to BA and almost a 0.7% chance it falls even further to B. It's these downgrade probabilities that we're about to use.
I know, that matrix might look a little intense, but trust me, the logic behind using it is actually super straightforward. Let's just walk through a really simple example, step by step. All right, so let's put ourselves in the shoes of a risk manager. Let's say in your portfolio you're holding a bond that's currently rated BAA, or BBB, and you need to figure out, what is my potential worst-case loss on this thing over the next year? So, pulling those numbers from our matrix, we know there's a huge 85% chance that the bond's rating doesn't change at all. Then there's about a 4% chance it slips down just one notch to BA, and a tiny, less than 1% chance it falls 2 whole notches to a B rating. Now, this is where the magic really happens. We can start adding these probabilities together to build a confidence level. So if we take the chance of the bond staying B, that's 85.4%, and we add the chance of it slipping to BA, that's another 3.7%, we get a total of about 89%. Let's just round it to 90% to keep it simple. So what does that tell us? It means we can say with 90% confidence that based on all this historical data, the worst this bond's rating will be in 1 year is BA. See? We just defined our worst-case scenario inside that 90% boundary.
So, let's put that all together into 4 simple steps. Step 1, you pick your asset, our BA bond. Step 2, you choose a confidence level. We just built a 90% one. Step 3, you use that matrix to find the worst possible rating inside your confidence level. For us, that was BA. And now for the final, most important step. You calculate how much money you would actually lose if that bond's value dropped to the new lower price that matches that BaR rating. That final number, that is your credit VaR. Okay, so that's a pretty neat calculation. But why does it matter so much? I mean, why is this so important in the real world? Let's zoom back out and take a look at the big picture.
Credit VaR is, and this is no exaggeration, absolutely fundamental to modern banking. It's how banks measure what they call unexpected loss, that worst-case scenario we've been talking about. And this isn't just for them. Financial regulators, using these global rules like Basel III, use these very calculations that tell banks exactly how much capital they need to keep sitting in reserve. That capital, it's like a buffer, a giant financial shock absorber, a safety cushion designed to soak up massive losses and prevent a collapse that could threaten the whole system.
So, to wrap it all up, let's just hit the main takeaways one more time. First, remember, credit VaR is about the risk from declining credit quality, not just outright default. Second, it isn't just guesswork. It uses historical data tables to map out possible futures. Third, it puts a hard number on a worst-case loss for whatever confidence level you choose. And finally, it's pretty much a cornerstone of how banks and regulators manage financial risk today.
And all of this brings us to a really big central question in finance. If we have these incredibly sophisticated models, all built on decades of real-world data to manage risk, why do financial crises still happen? It's a pretty powerful reminder that even the best models have their limits, and that it's always a challenge to predict a future that doesn't necessarily look like the past. Thanks for tuning in.